gold gave up about half of its $100 gain. We closed just above 4,050. Silver up about $1, closing at 58.58. Now, one of the reasons there could be some nervousness surrounding tomorrow's release of the PPI, when people believe higher inflation is bad for gold, when in fact gold is an inflation hedge. And the more inflation we have, the more you need to hedge yourself. Again, the government tries to tell us that prices going down would be horrible. How would it be horrible when so many people are suffering from high prices? Look how much food prices have gone up. And then the Fed monetizes those deficits, artificially suppresses interest rates in large part to make it possible for the government to finance those deficits without having a crowding out effect on private credit and pushing up interest rates. Middle class don't have a lot of savings anymore because taxes and inflation have pretty much wiped it out. They still have pensions, annuities, cash value in an insurance policy. They have a lot of saving vehicles that get harmed. So the markets immediately celebrated. Bond yields fell, bonds rose, and gold spiked $100 an ounce. Now, first of all, it's not even really good news on inflation, because the main driver of the 0.4% drop was the oil price decline. Oil was down about 30% in May. Why? Well, because supposedly the war with Iran was over. We had the MOU, we had the ceasefire, so oil prices went down 30%. Well, now the ceasefire is off, the war is back on, and oil prices, which are now back up at $80 a barrel as of right now, oil prices are up 20% so far in July. So July is only half over. It's possible that the entire drop in oil prices that we enjoy in May, or in June rather, because the war was off, are going to be taken away in July because the war is back on. So why even celebrate what really amounts to a meaningless number? What's more important is that we're way above 2%, and we're not going to get anywhere near 2%, no matter what the Fed does. And of course, what's more problematic is that these are the government numbers, the official government measures of inflation, which maybe capture half of the actual price increases that Americans are forced to endure. Now, gold gave up about half of its $100 gain by the end of the day. I think gold ended up closing up about $50 on the day. We closed just above 4,050. Silver up about $1, closing at 58.58. It got clobbered a couple of bucks yesterday, but I think the most significant action was in the bond market, because the bond market lost almost the entire gain.
Markets cheered softer inflation, even as the forces driving it were already reversing beneath the surface. Peter Schiff notes that falling oil prices temporarily distorted the inflation picture, exposing how quickly headline optimism can unravel. If energy rebounds while official inflation remains elevated, investors relying on government data may underestimate future purchasing power erosion. Next, Peter Schiff reveals why the bond market's reversal contradicted the celebration from the opening bell.
By the end of the day, the yield on the 30-year Treasury was back up to 5.1, and the 10-year is back to 4.59. So almost the high watermarks, despite this better than expected inflation number. Now, one of the reasons there could be some nervousness surrounding tomorrow's release of the PPI. We're going to get that tomorrow morning before we get day 2 up on Capitol Hill. And the producer prices have been coming in a lot hotter than consumer prices. Of course, the producer prices are also going to benefit from the drop in oil prices that we had last month, which is pretty much being undone this month. So again, I don't know why the markets would pay attention to such backward-looking data that is really irrelevant, but that's what they do. And this is how these algorithms are programmed, and they trade off the numbers. I just think that people should take advantage of any of these moves. In fact, when people believe that inflation, higher inflation, is bad for gold, when in fact gold is an inflation hedge, and the more inflation we have, the more you need to hedge yourself, should take advantage of this misguided idea that higher inflation is somehow bad for gold because it means the Fed has to fight harder to bring inflation down. What it really proves is that the Fed can't bring inflation down. It doesn't have the wherewithal or the ability to do it because of all the other problems that would be exposed if the Fed were to do that. And that kind of brings me to the discussion of today's hearing before Congress. And what's the most frustrating part, of course, about the entire hearing is that they're there to discuss inflation.
The biggest warning wasn't inflation data, it was bond yields refusing to believe the headline. According to Peter Schiff, stubbornly high treasury yields signal investors doubt the Fed's ability to restore lasting price stability despite favorable reports. That disconnect matters because markets often price future risks long before official narratives acknowledge them, leaving unprepared savers exposed. Next, Peter Schiff exposes why Congress keeps debating inflation without confronting its true source.
And nobody, except maybe Walsh, but he doesn't want to let the cat out of the bag. But the entire discussion centers around a term that nobody properly defines. Everybody acts as if inflation is rising prices. And it's not. I've talked about it on this podcast many times. Inflation is an expansion of the supply of money and credit. That is what is being inflated. You can't inflate a price, you inflate money supply, because inflate means to expand. And if you're going to have a discussion about inflation, but you're misdefining what the term means, then your whole discussion is meaningless. Because prices go up, prices go down. Inflation is a whole different problem that causes the general price level to be higher than what it otherwise would have been absent the inflation. It doesn't even mean that prices go up. It can simply mean that inflation prevented prices from going down. Now, again, the government tries to tell us that prices going down would be horrible. How would it be horrible? Especially when so many people are suffering from high prices. Look how much food prices have gone up over the past several years. Would it be such a disaster if they came down? Of course not. I mean, why do they have to keep going up? If the problem is food prices are too high, having a target of, well, let's have them go up another 2% a year, that doesn't solve the problem of prices being too high. That makes them higher. What would solve the problem is if prices actually came down. And that would solve a lot of problems. Consumers want the price of everything to go down. Yet, according to the government, that would be a disaster. The government is there to make sure that prices don't go down, to save us from the pain of being able to buy stuff for less, right?
The entire debate changes once the definition itself is challenged. What Peter Schiff is highlighting is that confusing inflation with rising prices allows policymakers to focus on symptoms while avoiding the monetary expansion creating them. If the diagnosis is flawed, every proposed solution risks extending the very problem households are trying to escape through higher living costs and weaker purchasing power. Next, Peter Schiff unravels why falling prices are treated as a greater threat than persistent inflation.
This is what the government is selling us on. So that's the biggest problem is a misunderstanding of the term. But then the other thing that really frustrates me always about these hearings is that you've got all these congressmen and women, right, that are upset about inflation, and they're asking the Fed, what are you going to do about it? What's your plan? How are you going to stop this inflation? Meanwhile, they are part of the reason that we have inflation. It takes two to do the inflation tango. Congress has to spend money it doesn't have. It has to have deficits. And then the Fed monetizes those deficits. And the Fed artificially suppresses interest rates in large part to make it possible for the government to finance those deficits without having a crowding out effect on private credit and pushing up interest rates. So it is the Congress, and of course the president, because he's signing on to all this spending, and the Fed. It's a combination of monetary and fiscal policy working hand in glove. That is why there is inflation. Yet the very congressmen and women that are voting for the deficit spending that is ultimately the source of the Fed, of the inflation that the Fed creates, they're yelling at the Fed as if they have nothing to do with it. They need to look in the mirror and recognize their own responsibility. And then, of course, the Fed chairs, they always deny their responsibility. They want to blame tariffs. They want to blame the war. They want to come up with all kinds of excuses about where inflation is coming from. The cause of inflation is right there in that hearing. It is being caused by all the representatives and the Fed. They're there discussing a problem that they've created, and they're pretending that there's some exogenous solution.
Public hearings often create accountability theatre, while the underlying incentives remain untouched. Peter Schiff's argument suggests inflation cannot be separated from persistent deficit spending paired with accommodative monetary policy, regardless of political messaging. Investors should pay closer attention to government financing needs than headline speeches, because fiscal dependence increasingly shapes future monetary decisions and long-term currency stability. Next, Peter Schiff reveals the contradiction between blaming inflation and simultaneously funding the policies that fuel it.
And then when Warsh talks about how, we're going to do things differently, we're going to solve the problem, without actually getting into what would need to be done to solve the problem, which is why they're not going to solve the problem. But artificially low interest rates also have clear winners and losers. Who wins from low interest rates? Debtors. The debtors win. Who loses? The creditors. They lose. So it absolutely does pit one interest against another. It favors the debtor relative to the saver, especially wealthy leveraged debtors who have borrowed to accumulate assets. They really win because it makes it cheaper for them to borrow. And then inflation wipes out the value of what they owe. So they're winners. The losers are the savers, which tend to be more of the middle class. And even if middle class don't have a lot of savings anymore because taxes and inflation have pretty much wiped it out, they still have pensions, annuities, cash value in an insurance policy. They have a lot of saving vehicles that get harmed by inflation. But also, who benefits from artificially low interest rates? The government, the federal government. The government is the biggest debtor of them all. So the government wins, but the savers, the people who bought government bonds, the people who loan money to the government, they're losing, right? They're getting a lower return. And who owns a lot of those government bonds? Insurance companies own those government bonds. And that means they have to charge higher premiums to Americans who are buying fire insurance, life insurance, car insurance, because they're not getting as high a yield on their bonds. They have to charge higher premiums to their customers.
Low interest rates rarely feel dangerous until the hidden costs begin compounding across an entire household balance sheet. This is where Peter Schiff's thesis shifts from policy theory to everyday financial reality, showing how suppressed yields quietly transfer wealth from disciplined savers toward leveraged borrowers and governments. Insurance costs, retirement income, and purchasing power all weaken while debt becomes easier to sustain. Next, Peter Schiff exposes why this redistribution is rarely acknowledged in mainstream economic debates.
So that's another way that the middle class suffers from artificially low interest rates. And the government benefits and other debtors from the ability to borrow. So I don't know if Warsh actually believes this. This is a very simple point. Does he not understand that there are two parties to a loan? There's the lender and there's the borrower, and that if you advantage one, you disadvantage the other. Does he not get the distinction there? I don't know, but that's what he said. And I was actually surprised that he made a comment that was that incompetent. Now, another point that I wish he would have made more clear had to do with black workers. And, whenever there's one of these hearings, inevitably you get an African-American representative, typically, asking the Fed chairman, what are you going to do specifically to help African-Americans? And in this case, it was African-American workers who this representative claimed were disproportionately impacted by rising unemployment or inflation, whatever it was. But she kept saying, what are you going to do specifically to help African Americans? Now, Warsh just ignored her question, which probably upset her, which is why she asked it a couple of times. But I wish he would have just had the courage to be more candid and actually reply and say, you know something, Congresswoman, there's nothing we could do. I understand you're concerned about the plight of black workers, but the Fed can't do anything about it. Like we can change interest rates, but how does that affect a black worker versus a white worker or a Hispanic worker?
Simple financial principles often disappear once they collide with political narratives. Peter Schiff notes that every loan creates both a borrower and a lender, meaning policies favoring one side inevitably burden the other, despite promises of universal benefit. That overlooked trade-off helps explain why many middle-class savers steadily lose ground even during periods promoted as economic success. Next, Peter Schiff reveals why the Fed cannot selectively solve social challenges through monetary policy alone.
I mean, they're all the same, right? We have, a couple of levers, right? Print money, don't print money, cut rates, raise rates. There's no, lever that we can pull for African Americans. There is no specific policy that can be targeted. Why not just tell her that? Why not just level with her and say, look, this is not the place for you. He's afraid. He's afraid to speak up. Nobody wants to criticize anybody for asking these ridiculous questions. But even better, what I would love to see Kevin Warsh do is say, you know what, Congresswoman, I appreciate that you're concerned about black workers and, the problems that they're facing. Why don't you do something about it legislatively? Why don't you start repealing a lot of the laws that Congress has passed over the decades that are disadvantaging African American workers? They are being disproportionately impacted by all the war on poverty, Great Society, welfare programs starting from the 1960s. And all of the laws, the anti-discrimination laws that have been passed have backfired. Everything the government has done to help African Americans has backfired and harmed them. It's got nothing to do with the Fed. Yeah, I mean, the Fed harms everybody, right? They're an equal opportunity harmer. Their bad monetary policy and their inflation, sure. And you can say, well, if blacks are disproportionately poor and middle class, then maybe they disproportionately suffer relative, from inflation, which may be true. But there's no way that the Fed can target that relief to the African Americans. Right?
When institutions are expected to solve problems beyond their mandate, accountability becomes increasingly blurred. According to Peter Schiff, Monetary policy operates broadly across the economy rather than targeting individual demographic groups, making many political demands fundamentally mismatched with the Fed's actual tools. Investors should recognize this gap because misplaced expectations often distract from the structural drivers influencing inflation, employment, and long-term wealth creation. Next, Peter Schiff exposes where political responsibility ends and monetary responsibility truly begins.
They could just paint with one big brush. But if Congress actually repealed a lot of these laws that, maybe they were well-intentioned. I'll give them that they had well intentions. But, the road to hell is paved with good intentions. And in this case, it's the African Americans who are in hell as a result of that well-intentioned legislation. Now, in many cases, it wasn't well-intentioned. The actual purpose of the legislation was to trap African Americans in poverty to secure their votes so that they can hold out an escape from poverty.
Policies should ultimately be judged by outcomes rather than the intentions used to justify them. What Peter Schiff is highlighting is that long-term economic incentives can produce consequences far removed from their original promises, regardless of political branding. For investors, separating measurable results from persuasive narratives is often the difference between protecting wealth and reacting to headlines after the damage is already done,